Hey, how's it going, everyone? This is Mike with InvestTheory.com. Welcome to episode 2 of our option spread series, where we're going to be taking an in-depth look at the bull call spread. Now, before we dive into specific examples of how to use the bull call spread, let's quickly refresh on what the vertical spread is and why we would want to use it. So as we learned in episode 1, the bull call spread is a bullish position. Now, in order to set it up, the trader needs to buy a call option with a lower strike price, at the same time selling another call option with a higher strike price. Again, both calls will need to have the same expiration date. Now, the reason why we would want to set up a bull call spread is because we believe that the underlying stock is going to have a moderate increase in value, meaning we think the price is going to go up, but not by a lot. So using the bull call spread strategy, it allows us to enter into the trade with a cheaper overall price than if we bought long calls. And here's a diagram that shows how the bull call spread enters into our profitable and non-profitable zones. Now remember, since there's defined risk, there's also defined profit. So we have a max loss and a max profit that we can see right here on this diagram. So let's take a look at an example. Let's say that we've got stock XYZ and it's currently trading at $45 a share. Now we believe that the price of XYZ is going to increase by a small amount sometime in the near future. Now we have a couple of choices when buying into a stock option. Since we are semi-bullish on the underlying stock, we can purchase a long call with a $42 strike at $1 a contract, or we can open a bull call spread and risk less upfront cash and play the trade a little bit safer. Again, since we believe there's going to be a moderate increase in price, it might not be a bad idea to have defined profits in this trade and limit our risk. So how do we do this? Well, first, we're going to buy one contract at $1 with a $42 strike price. We're then going to sell one contract for 40 cents with a $44 strike price. Now, to determine the net cost of the trade, we need to take our buy of $1 and subtract the sell of 40 cents. This gives us our net cost of 60 cents, or $60. Now remember, our goal is to capture the moderate gains in the underlying asset while risking less upfront cash. So this means if the price of XYZ ends up increasing to $44 or more, we've reached our max profit area. So let's say that XYZ makes a surprise announcement. They're going to release an amazing product that is going to absolutely change the world. Well, we're going to miss out on all that extra profit because we're going to be maxed out on this spread. So to figure out our max profit, we need to do two things. First, we need to subtract the $42 buy strike price from the $44 sell strike price. We then need to subtract the net cost of the difference of those strike prices. This gives us a max profit of $1.40, or $140. So again, to figure out the max profit, we need the difference of the two strike prices and then subtract the net cost. So we have our max profit, but we also need to know what our max loss is. With the bull call spread, our max loss is the total net cost that we paid up front. So for this trade in particularly, we have a max loss of 60 cents or $60. Now this means we are risking $60 in hopes to make up to $140. That is very good. Now before we can take our trade though, it's important that we understand what our break-even price is as well. So to determine the break-even, we just need to add our buy strike with our total net cost. In this example, we have a $42 buy strike and a 60 cent upfront cost. That means our break-even price is $42.60. So here's what this example of XYZ stock looks like on our bull call spread diagram. As you can see, we have our max profit and our max loss defined. We can also see where our profitable and non-profitable zones are easily located at. Some people have asked me if these diagrams are required, but the answer is no. While they're helpful, they're definitely not necessary. It just helps, get a visual of how the spread can play out. Now let's take a look at a real-life example. Here's Microsoft's September 21st strikes and call prices. The current price of Microsoft at the time was $108.18. We decide we want to open up a bull call spread on Microsoft and choose to sell the 109 strike price for $2.48 and buy the 107 strike price for $3.60. Now remember, in order to find our net cost for this trade, we need to subtract the sell of $2.48 from the buy of $3.60. In this case, our net cost is $1.12 per contract, or $112. Now to determine our max profit, we're going to take our sell strike price of $109 and we're going to subtract the buy price of $107 along with our net cost of $1.12. In this example, our max profit is 88 cents per contract, or $88. So our max loss for this trade is going to be the net cost that we paid up front. In this trade, it's $1.12, or $112 in total. So to recap, we are risking $112 to make up to $80. Now our break-even price for this trade is going to be the buy strike of 107 plus the net cost of $1.12. So our break-even price is $108.12. Here's a diagram that shows our profit and our loss. Now remember, we would open this bull call spread if we think there's going to be a moderate increase in Microsoft. This allows us to hopefully capture a profitable trade in Microsoft without tying up too much money at the same time. So to recap, our net cost is the buy minus the sell. Our max loss is the net cost of the trade. Our max profit is the difference between the sell strike and the buy strike minus the net cost. And our break even is the buy strike plus the net cost. The bull call spread is a good strategy when you believe the stock will see a moderate increase in price. While you limit the amount of profit that you can capture, you also limit the risk that you take at the same time. Tune into episode 3 where we're going to give an in-depth guide on how you can trade the second strategy in the vertical spread series, the bear call spread. If you're looking for a knowledgeable and fun community of traders to hang out with and share ideas, look no further. Invest Theory has brought over 3,000 traders just like you together in one free Discord chat. Join by clicking the link in the summary today and see how you can become an even better trader. This is Mike with InvestTheory.com, signing out.